So if you check the information again, we must also refer to the adjustment again to say check whether the transaction was recorded or not. Now if you refer to information G, it says the last sentence there, we are on this sentence, it says this transaction has not yet been recorded by the bookkeeper. So remember, if it was recorded, it was supposed to be subtracted on the asset that we have, but it was not recorded. It says this transaction has not yet been recorded by the bookkeeper, so it was not recorded, the 235. So we must go back and check our trial balance. How much was the assets on the trial balance? There we are on vehicles, it was 844, but remember they said the asset that was sold was not recorded. If it was not recorded, and it was supposed to be recorded because we are supposed to subtract, it was not recorded, it means the 235 is not yet subtracted from the 814. So it means 814 represents the beginning, and 814 cannot be unsold assets because from the 814 the 235 was sold and was not recorded. So we'll calculate and then we'll take our, now we want the old ones or the unsold ones. So we say the one that were not sold, we had 814,000 minus 235. We subtract 235 because it was not recorded. So 814 minus 235, it will give us 579. It will give us 579,000. And sorry, 814. Remember, now we are looking for the old ones, the ones that were not sold, because the 235 was sold but not recorded. So 814 represents the beginning. We started with 814, we sold 235, we are now left, that is the remaining assets. We are now left with 579 as our assets, multiplied by the depreciation rate 15% over 100, and we had that for the whole year. So we'll calculate, let's quickly use our calculator. We'll say 814 minus, and then we get 579. 579,000 minus, 579 multiplied by 15 divided by 100 multiplied by 15% would give us 86,880. 86,850. So this is also depreciation on the remaining vehicles. So we are done with the vehicle, so we'll record as part of our calculation there, plus 86,850. 86,850. Now we are also going to check the equipment. Information H, it says make provision for depreciation as follows. There is a note, the new equipment to the value of 48,000 was purchased on 1st September. So it means this is now the new one. We calculated the first one, the second one, the third one is the new one. How much is the new one? It said there is 48,000. So 48,000 multiply, we said depreciation rate, there is 10% per annum on diminishing balance, multiplied by 10 over 100, and then we said we're also going to check the lifespan. The asset was purchased only on the 1st of September. So it's there. It was purchased on the 1st of September 2010. So 1st September 2010. So we had the asset from here up to there. So we must also count months from September to the end of the accounting period. So that will be September, October, November, December, January, February, March, April, May, June. So we'll have 10 months. So remember, when you count months, you check the day, whether it's the first day of the month or the last day. Remember, we talked about that when we started with this. So it's 10 months. So we'll say multiply by 10 over 12 to get depreciation on the new equipment. So let's check the, we'll calculate the 48,000 multiply by 10%, multiply by 10 divide by 12 equals to 4,000. So 4,000, that's another depreciation on the new equipment. So we have depreciation on the new equipment 4,000. So we are left with the old equipment. Remember, this one is new, and that is not the only equipment that we have in the business. So we have the old ones. If you refer to your trial balance, it says the equipment 616,000. So we must first check the new one, was it recorded or not. So if we go back to the adjustment, it says adjustment number H, the last sentence, this started there, this has been correctly recorded. It means the 48,000 was already recorded in the books. If it's recorded because it's a new one, it means it was added. And we cannot calculate depreciation on the figure that include 48,000 because 48,000 only had a lifespan of 10 months in this accounting period in the business because it was new. But we have the old ones that will assume that they were there from the beginning. So let's check the trial balance. Trial balance, we are having 616 for equipment, and the 48 was recorded. It means the 48,000 is included in the 616,000. So we cannot calculate depreciation on the 616 because 616 include the 48,000 because it was already recorded, and we are supposed to calculate depreciation on the 48,000 separate because that is the new one. So with the old one, we'll say 616 as given from the trial balance, 616,000 minus 48 because 48 was recorded, so it means it's included, so we must subtract it. So it will give us 568,000. But if you refer back to the adjustment again, it says depreciation equipment at 10% per annum on diminishing balance method. With diminishing balance method, it means cost price minus accumulated. If you say 616 minus 48, we are left with 568,000. That is our cost price. But then we must check the diminishing balance method. We need also the accumulated depreciation. If you refer back to that accumulated depreciation, it's there 341. So we'll say 568 minus 341,000. It will give us something. Let's check. 568,000 minus 341. It will give us 227,000 as our carrying value. Multiply by the percentage, 10%, it will give us 22700. So this is also depreciation on the old asset. Now let's check. We had depreciation there on the sold asset. We had depreciation there on the old vehicles that were not sold, and then we had depreciation there 4,000 on the new equipment. We also have depreciation there on the old equipment that were not sold. So together they will give us amount that is regarded as expense. They will say plus 20,700, and then we'll add everything. If you add everything, you'll end up with a figure 131,000 for depreciation, 175 for depreciation. So that is that. So you must remember, we said how to use the brackets for in your calculations.